Section 452 is the value added tax. And as you said, it creates a new Internal Revenue Code, Chapter 7, with 7 subchapters. And the first one is the imposition of the tax. I'll go ahead and share my screen. So the first chapter is the part that actually imposes the tax. And I took computer programming back in high school many years ago. And the computer programming teacher was like, when you get good at this, your actual programs are just going to be a few lines long, and everything else will be done within subroutines. And that's kind of the scenario that we've got here. So I'm going to do some of this out of order. The definitions are where a lot of the heavy lifting is. And when we get to the part where it actually imposes the value added tax, is just a few sentences long. A value added tax is imposed on business activities in the United States by a business entity every taxable year beginning January 1, 2024. Remember, as we talked about the digital treasury accounts and the American Union Jobs Program, it's estimated that it may take 6 months to get those set up, which means that UBI would hopefully be starting by the middle of 2023. So months and months before the value added tax goes into effect, people would be able to, would have money to spend before the tax goes into effect. The tax is 12% of the gross profits of the business entity. And again, where this goes into effect, the secretarial right, rules, guidance, regulations, that sort of thing. So this is the value-added tax is applied to gross profits. And so section 1603 relates to tax-exempt organizations. So this doesn't apply to nonprofits. They will still pay the value-added tax when they buy goods and services. If this was I guess I'm not sure how it works in other countries, in Europe or whatever, if nonprofits and things like that are exempt from the value-added tax when they make purchases. But this is another reason to use the subtraction method so that it's lumped in there, that nonprofits are still paying the value-added tax and contributing back to the economy that way. And 1603 clarifies that it can apply to things like colleges and universities. They do vending. If they're doing things specifically for the production of income from the sale of goods or performances of services, that they can be subject to the tax based on that. All right, and so now let's break down exactly what the value-added tax, what it does. What are all these definitions? And I want to start with what is property as it relates to this. Property means a product for purchase or sale. It does not include real property, which would be like real estate, unless specified or clearly be applicable in a certain context. So property means goods that you purchase in the store. What is the business activity that the value-added tax is applied to? Business activity means the sale of property, the sale of services, the leasing of property, development of property or services for sale. But it doesn't include things like paying it. It does, like an employee's work, casual or occasional sales of property by an individual. So if you sell your 2020 pickup truck for $30,000, that would not be a business activity that would be taxable because it's an occasional sale by an individual. Value-added tax applies to business entities. Who are business entities? Business entities are any corporations, unincorporated associations, individuals, partnerships, anybody doing business, with a couple of exceptions. One is government entities. Government entities doing essential government functions, the Department of Motor Vehicles or things like that, those would not be subject to the value-added tax. And the other part of this is a safe harbor for small businesses. Business entities do not include an entity whose taxable receipts are less than 3 times the basic wage. So $15,600 a year. 3 times that is $9,800. So if your taxable receipts are under $50,000, then you are exempt from the value-added tax. If you're a small business just starting out, this burden isn't on you until you're making 3 times as much as the basic wage. And so this protects, all of the kids doing their lemonade stands or mowing lawns and things like that be subject to the value-added tax. All right, the next definition, this applies to the gross profits. What are gross profits? Gross profit means for a taxable year, the amount by which the taxable receipts exceed the deductible amounts. So what are the receipts? What are the things that we count as sales? Taxable receipts includes if you're in a gambling business, buying tickets and things like that. It includes in-kind receipts. It does not include any taxes that are separately built into the price of things. So if you're selling something that has a sales tax and you collect the sales tax for a state, the sales tax itself is not included as a taxable receipt for your accounting purposes. Financial receipts, performance of services, kinds of services that included in taxable receipts, including renting real estate, doing performances for entertainment purposes, advertising. If you sell advertisements, Google, we're looking at you, that is a performance of service, and that is a taxable receipt. And what's not included in taxable receipts is exports. This is a tax, this is an American tax that we still want to remain competitive in the world. And so exports from the United States, things that you sell outside the country, would not be subject to the value-added tax. There is one exception to that, unless the exports are subject to Chapter 39 of Title 22, which is the Arms Control Act. If you are selling bombs and other munitions and weapons of war outside the United States, a strong argument to be made that you are not adding value, and those sales will be subject to the value-added tax here in the United States. And in such cases, if you sell them to the government, who then exports them and uses them outside the United States, that is deemed as they would still be taxable. They wouldn't be exempt. All right, those are what taxable receipts are. What about, so again, gross profits are taxable receipts, which we just covered, minus the deductible amounts for the year. So deductible amounts means the cost of business purchases, excluding anything such as that's exempt, like exports. All right, so what are business purchases? What are the allowable deductions? So here's what we've got. Business purchases include purchase of supplies and inventories, the things that you use to make the product that you sell. Purchases of services from independent contractors. Now, independent contractors have to be business entities in order for this to apply. So if you are a business that is trying to hire, say, delivery drivers at low wages, those delivery drivers are exempt because they're not making $49,800 a year in gross receipts. They're exempt from the value-added tax. Then it's not a purchase of services that you can deduct. You would be responsible. You wouldn't be able to deduct those amounts unless somebody else is paying the value-added tax on those. Business purchases also include financial intermediation services, which we'll get into later. Imports. If you're importing something, it does not include the import tax, just the underlying value of the price of the good or services. Business purchases include any payouts. Again, if you're a gambling games of chance, your payouts count as business purchases. But here's what business purchases do not include. They do not include compensation expenses for an individual. So this is the part where if you're adding value to the company, if you bought $1,000 worth of raw material and sold your product for $1 million, and you say, oh, well, I'm paying myself $900,000 and then the rest is profit. No, compensation expenses are not a business purchase. It does not include the purchase of or rental of real property. So again, if you made a lot of money in your company and you're like, hey, what if we just buy a bunch of real estate and then say we don't have any profits for the year, so we don't have to pay any taxes? Purchase or rental of real property is not a business purchase. Applies to purchase or rental of capital equipment, property outside the United States. This is performed outside the United States. So if you are subcontracting with a business entity overseas, then that doesn't count as a business purchase that you can deduct from your gross profits, unless you treat it as being imported into the United States. Some other things as far as taxes, paying taxes doesn't count as a purchase. Do not include the taxes. Does not include political contributions. You can't write those off as a business expense, and expenses related to advertising. Advertising advertising is not part of the inherent the product or service that you're selling. It's a separate thing. So I think those are the main definitions in here that pretty much lay out the framework. Everything else in here I think is pretty self-explanatory stuff about the Internal Revenue Code and things like that. And so with that, I think next year that'll conclude my testimony for Subchapter A, and now I'd be happy to answer any further questions.
Fantastic. Yeah, you got right to the part that set my mind straight. Thank you. I do remember the other thing I was gonna ask about. We have this line drawn at $49,800, but if an individual brings in 52 grand, all of a sudden the 12% applies to that entire 52 grand. Is that correct?
That's correct.
Wouldn't it make more sense just to exempt the first 50 grand and then anything above that gets taxed? So that way you don't screw over those businesses that are just right on the edge? Maybe.
I'm not 100% sure. The other part is that the safe harbor will, as we talked about, the universal basic income will be tied to inflation. And so as the basic wage goes up, the safe harbor will increase too. As you know, this is sometimes a problem we have by writing fixed dollar amounts into the law. So the safe harbor will increase as well.
Right. So, I mean, replace the term 50,000 with the safe harbor line, whatever that safe harbor line is. If you come in just above it, I could see that then all of a sudden having to pay 12% on all of that could be like problematic for a small business. Whereas if you only need to pay 12% on that last 5 grand or whatever it is, may be much more reasonable for a business of that size. And when we're talking about companies like Apple and Amazon, there would be a negligible difference.
Yeah, I think that's something we could look at with the subcommittee. I guess the other part of that is, so remember, so if you're a small business owner or an independent contractor, right? And you work for Amazon and Amazon pays you $48,000 a year, then Amazon is responsible for covering the value added tax because you're not legally a business entity, which then is, so then what happens if, I guess where I'm going is, so somebody's already covering that tax on the first 50,000. And so if you create a safe harbor, I feel like you could be creating a loophole where you allow separate business entities to each deduct $50,000 of their gross profits, where you'd create a financial incentive to split it up as into a bunch of different entities who each be able to deduct 50,000. But anyways, we can look at this in the subcommittee.